waves which are about to hit us. These are not the health waves that are as a result of what's happening with the coronavirus crisis. It is about the economic crisis waves that are actually coming our way. And I'm going to go through these so that if you happen to be an experienced investor, or you're just getting started with your first investment, or frankly, even if you're just running your own business, or even just lost your job, you're going to have very specific steps you can take based on these waves. And the other thing I want to share is that these waves may not be what you're seeing currently in the news, right? At the moment, there's news about the stock market rally taking place. There's news about, like states and governments opening up their borders again, opening up like their economies again. No, this is about the data, the detail of what's really happening out there right now. I do know when I go through these waves, you might be shocked to hear some of the numbers I'm going to give you. But on the other hand, there are some very specific steps you can take as a result of this as well. And just before I get into these ways, because we just actually had an investor call where we had several thousand of our investors go through these ways and actually take actions based on what has to happen next from all around the world. It really brought me back to a story from 1997. That was when it was the Asian crisis. And at that point, I was just getting my first business in Singapore getting started. I met up with a Malaysian entrepreneur whose name was Tony Fernandez. Tony, at that point, had just bought AirAsia for $1. Well, actually, it wasn't $1, it was a ringgit, which is the Malaysian currency. And he bought it for 1 ringgit, which I think is maybe 20, 30 cents. And he said that the reason he was able to buy it was because the Malaysian government, who basically ended up taking over AirAsia because it had fundamentally gone bankrupt. It had assets, like it had airlines, for example, it had all the contracts with the airports, but what it also had was massive debts. And as a result of those debts becoming untenable, they said, can someone just come and just solve this problem? He came along and said, I'll buy the entire balance sheet for a ringgit. And then he took it over and then he renegotiated all the debts. He cleared them all out. And then he ended up going out and becoming a multimillionaire much faster than he possibly could if he was actually starting his own airline from scratch. We are living in the first time in 20 years, in 2 decades, where we're seeing the same kind of stories now play out as well. And it's as a result of these 3 ways. So it doesn't matter if you're there currently thinking about how do I actually go out and start my next business through all of this? How do I just even survive through all of this as well? I know you're going to get some great lessons as we go through this. Wait until the end when we're actually going to go through also the big 5 actions that you can take off the back of this as well. Okay, so first of all, let's just have a look as we get into this first wave at a couple of different articles. This first wave, by the way, is about consumer debt. So this is all about consumer debt defaults, the fact that there are many people out there with loans and with credit cards and with mortgages, which are all coming due, and where even if they're stopping themselves from paying those for a while, we're going to see this grow to a whole different level. Here is an article from Bloomberg from the end of March. A global consumer default wave is just getting started. This is actually quoting from, as you can see here, Chinese data, where you can see, and this is the same all around the world, but it just so happens China's a few months ahead of the rest of the world when it comes to the crisis. You can see just how much over 10 years the actual household loans have been growing in China. They've quadrupled over that period of time, while the GDP has been coming down, which is your ability to actually even pay if the country is not making the products and services necessary to actually cover those debts. Then of course it's going to get to a point where the whole thing is going to collapse. So it's not the coronavirus crisis that's created the economic crisis. It's simply triggered it, in that it was already ready to come. And I know many people, as you know, who are out there already predicting that we were going to see another downturn. And so we are seeing right now defaults in China on credit cards already up 50%. This article here, this is in America, 31% can't pay their rent, right? We're now going from 30 to 40% of people defaulting on their rental payments and this is for their residences, right? This is their actual homes, as well as any investment properties. This is not even including corporate, like the shops and the restaurants. I mean, they're at a much higher default rate. They're already at up to 85%. But you're seeing here as well, in terms of mortgage defaults, home lenders brace for up to 15 million mortgage defaults, right? So this is where people who actually owe money are simply not paying it right now. And the reason this is important is for the reason I'm about to share with you here. As a summary, this slide here shows you credit card debt already is 2 or 3 times up from what it used to be. And we're now at actually defaults of up to 20%, which is huge. We've got rent defaults already up to over 30%. We've got global household debt is sitting at $47 trillion, which is at a record. It's 12 trillion higher than during the global financial crisis. So it means it's got a lot further to go to drop as well, because we've actually got now a much higher debt pile sitting on households around the world. with unemployment rates tracking towards 25%, which we're going to see over the coming months. And again, it's not going to be an easy, quick recovery. What this means is that we are going to see many households have to either refinance their debt, end up in like credit card default, end up being evicted from their homes, or for that same challenge that they've got, having a knock-on effect on the finance markets, pretty much like 2008, where as a result of people not being able to pay back their debt, you ended up with all of the finance market itself starting to suffer as well. This, by the way, is not where the crash that is going to come is going to start. It's not going to be on the consumer side, because the reality is that if you have a mortgage for 20 years, you can always tag on another 6 months at the end of that mortgage without having to go broke right now. However, the next second wave is a much, much bigger wave. So before I get into the second wave, on this first wave, you might say, well, what can I do about this, right? If I'm in debt myself, then, there's nothing I can do, right? Like this is going to be an issue that is facing everybody. There actually is something you can do. You see, back in 2008, at that point, we had a financial crash, which was starting with the banks. This time around, it's not a financial crash. It's actually starting right now with us not being able to go to work. And so the opposite has happened. Whereas in 2008, the banks, immediately as soon as the crash happened, they stopped loaning out money. If you remember back then, 10 years ago, it was really difficult at that point to be able to get money from the banks. Whereas now it's easier than ever to get money, because the governments have been encouraging the banks to give out money. The governments themselves have been giving out money. And so we're actually seeing the loosest financial policy ever when it comes to getting loans in history. But this is not going to last more than 3 months, which means that you have got a 3-month window right now to max out your credit. Meaning that you should be going to get a remortgage on your property while you can. You should be extending your credit card while you can. You should be going to the bank and getting a loan and whatever you're able to get while you can. Not to just go spend it, not to go and just put good money after bad, but to have that as a war chest for what's about to come. So I summarize this as basically the very, very first step as being the great global giveaway, right? That we are in a position of time right now where you have a tiny window to max out your credit and get the cash that you need to ensure that you're going to weather this, and more importantly, so you actually have a way to be investing as well as looking after yourself as you go forward as well, right? Because this then leads to the second wave, which is where we're going to see, I believe, the entire economic crash and collapse happen. It's already started, by the way. This is the corporate debt market, and this is all about corporate debt defaults. This is wave number 2. This was not really that much of an issue during the global financial crisis, but here it becomes a much, much bigger issue. The reason for that is because while you'll have individuals who might have like 20-year mortgages, when it comes to companies, they normally have a 1, 3, or 5-year loan that they can take out, whether it's actually creating it as corporate debt through the banks, or whether they're creating it through getting financing from others. This is debt that needs to be paid back, and at the time when it is now due to be paid back, if you can't pay it back, you've only got 1 or 2 options, which is either you're going to go bankrupt, or you're going to have to roll it over, and you can only roll it over if you've got a healthy business that other people want to take that debt on, which is clearly not the case today. So as I actually speak, today I heard that Virgin Australia has just gone into receivership, right? Because they had a $500 million loan they just simply couldn't pay back. So instead they go bust, right? We're seeing this happen in all, we've had a number of the department stores where this is happening. Neiman Marcus, this just happened as well. And so how big is this issue? As you can see here, $66 trillion of global corporate debt is now at double the 2008 levels. Remember what I just said about consumer debt? Consumer debt is at 47 trillion. This is at 66 trillion. And 19 trillion of that is risky debt right now, of which over 4 trillion becomes due in the next 12 months, right? Basically, it means that it has to be paid, or else those companies are going to go bankrupt. And it also means, obviously, if a company goes bankrupt and the finance companies do not get paid, then the finance companies also lose out too. So we're actually seeing this now this is very much back to Tony Fernandez's case, where you've then got a situation where there are valuable businesses being sold for the dollar because people just have to get out because they are already in a situation where they can't pay back, or the bank has either reclaimed that property or reclaimed that business and then has to then resell it on in auction to others as well. But we're going to see all of this happening right now. And company rent is already at 85% default rate. So if we have a look here, here's a couple of different slides again that I'll just share with you. This one here, corporate debt was a recession time bomb. Coronavirus just lit the fuse. In this article here, it actually walks through how in exactly the same way that consumer debt has been growing over the last 10 years, corporate debt has been growing massively as well as free money has been out there. You can see from the graph just how much of a drop there's been in the demand in bonds and in any kind of debt that's available out there. You can see here from these articles, a wave of oil bankruptcies is on the way. This has already started. Whiting Petroleum, this is Whiting Petroleum, rising star in the shale industry, filed for Chapter 11 protection on Wednesday. Nearly 100 US oil and gas producers could file for Chapter 11 over the next year. This is, again, sector by sector. This is airlines. Many of the world's airlines could be bankrupt by May. I just mentioned Virgin Australia. I got a message from Richard Branson, which was saying that he's just focusing his time right now at just being able to save as many of his companies as he can right now. And you can see exactly what the challenge is globally around the world. It's not enough for the governments to just say they'll bail companies out, because there are companies like Virgin, which are based in the British Virgin Islands, and while they do business in other countries around the world, you can't say it's just basically the responsibility of one government, right? It's actually they're already doing international business. We're in exactly the same situation. We've got resorts, entrepreneur resorts, in places like South Africa, but we don't qualify for any of the loans from or the grants from the South African government. Same in Indonesia. We're having to just fend for ourselves in all these different places because most of their programs are for very local businesses that are locally owned, which obviously we're not. You've got here another article which is all around the hotel industry. Half of US hotels could close amid coronavirus crisis, industry exec says, right? And actually, again, gives you examples of some of those different hotel chains, some of which already have actually filed for bankruptcy or receivership as well. And you can see it very easily. Just go Google it and you'll find them out there right now. And this is in exactly the same case. If we actually were to shift everything around and all be back on our feet again, that would be great. But as you can see here, we have this article from Bloomberg, the Great Recession was bad, the Great Lockdown is worse. This is the IMF, the WTO, United Nations, all of them sharing just how bad things are looking right now. I mentioned about rental defaults. Fight over commercial rent gets ugly with default wave looming. Only 15% of all retailers, restaurant owners paid their rent in the last month. I mean, that is phenomenal. That means only 1 in 8, 7 in 8 did not even pay. That means two things. It means that when eventually they do open again, because right now there's no incentive to pay because they're not even at their location, but when they do reopen, they can't reopen with either, number one, renegotiating all their rents at a much, much lower rental, which means it's going to be the landlords that end up paying, or number two, not being allowed to open again because they haven't paid their rent, which means that we're actually going to delay any recovery even further as well. So what does this all mean to the market? What does it mean to you? Well, first of all, as a result of this, let me share the consequence. The consequence of it is the sale of the century, right? It's the fact that we are gonna, if you want to say, how do I build $1 million business out of this? The easiest way to build it is not to build it, it's to buy it. Is to say, well, where can I actually go find a company? And there's actually a link that will give you underneath this, which actually gives you a link to one of the talks I did recently around all the sites that are available that already are showing the liquidation sales, which are already showing the companies which are in receivership, which actually are looking for a buyer, the distressed sales, where you've already got companies actually looking for someone to simply take it on, often with vendor financing, which means they'll pay for you to take it on and actually be able to run it without them having the actual issues with it as well, which really does mean that you can go out and buy $1 million business for $1 if it's in your field and you think you can do a good job actually turning it around, right? So there's no better time than now to be actually getting yourself ready for what is the sale of the century and realizing that when you're actually taking on a company which might have been worth an awful lot more but no longer is, on the one hand, you're doing a favor for the owner who's just trying to get out of the situation. And on the other hand, you also are doing a favor for everyone who's losing their jobs if someone doesn't come in and buy the company out as well, right? So we are in a very, very unique situation that we're never going to see again. Now, before I get onto the third wave, and actually say, okay, if you're actually thinking about that, think, right, I should maximize my credit, I should be thinking about this corporate wave and how I can actually take advantage of this wave as well. Let me, before I get to the third one, just show this slide here about the 4 financial derivatives that make up an economy. So a couple of people I've been following just because they know their stuff. One of them is Bill Gates, another one is Warren Buffett, and the third one is Ray Dalio. They are all sharing their thoughts on the marketplace right now, and they're all looking at things on the trend of 100 years, right? Like what's likely to happen and the way it happens. And all of them have a very sound understanding of economics. And the basis of economics is understanding that everything derives from something else. And our entire market, which is what we're talking about here, is what's collapsing. It actually really can be summarized as 4 different levels. The first level is what we call the employment sector, because this is where you derive productivity from labor, which is our time, right? So we basically go to work and then we actually become productive in that work, and that creates the entire employment sector, right? And as long as that employment sector is running well, then you can then have the second sector really become healthy, which is the corporate sector. The corporate sector is where you actually derive earnings, which is corporate earnings, from all that productivity, right? So someone who knows how to work hard can be productive, but someone who knows how to actually design a business and actually go out to shareholders and say, hey, I've got a business worth something, can become a business owner, and that's where the corporate sector comes in. So what I've just shared is the two ways that are impacting these two different sectors. The third sector is the financial sector, because the financial sector then says, hey, we've got assets that we can actually derive value on, asset returns from the earnings. You know, that's when like a landlord says, okay, I'm going to actually like rent out my building to a company owner who's going to actually rent it, or I'm going to have an airplane which I'm going to finance so that an airline can actually use it. And that works fine, provided the first two levels are actually working. When we had the 2008 global financial crisis, it was actually this third level, the financial sector, which was collapsing. And it didn't affect all of us at the other two levels. But when you have a third floor of a building collapse, it does impact the first two levels as well. What's happening now is actually the opposite. What's happening now is that it's the employment and the corporate sectors which are most at risk because they're the most highly leveraged. And now, because of the coronavirus, we're all being like stuck at home. So those two have totally collapsed at the moment. And the financial sector is now just being held up by the top floor, the penthouse, which is the government sector. Government sector is where you're now deriving taxation and all the national earnings from the returns from the financial, corporate, and employment sectors. So effectively now, the penthouse is holding up everything else and is basically like, you know, got this levitation thing going on where it's saying, we're just going to pay for you guys to actually just keep the thing going and for as long as possible and try and hold it up until you realize that you can't hold it any further, because the only way that government can actually hold itself is that it prints money, because it's not clearly not getting money from all the way down this pathway. And that is not sustainable more than 3 or 4 months. It definitely isn't sustainable more than 6 months, right? So this is what we're actually seeing happen at the moment, where the financial sector, which was the most at risk in 2008, doesn't even actually show up in these first 3 waves. The first 2 waves have gone through. The third wave is now the government wave itself, right? So the third wave that I'm going to share here, which becomes really important when I get to the end of this video and show you what these different steps are, is around sovereign debt default. So this is like countries defaulting on their debt as well. It will not be America, or it will not be like Germany or England, which will be the first companies to go bankrupt. It'll actually be some of the some of the African or South American countries will be the first to go there. So if I actually show you a couple of these headlines here, this one here from BBC News: coronavirus, world economy may face double recession. This just came out this week. And this is talking about how the first recession comes from economies imploding, but the second one comes from the governments that actually manage those economies actually collapsing as well. And so you can have a look at this article, and we'll drop links to all these articles so you can see them here as well. And by the way, this all is part of the full 1-hour webinar that I ran with our investors. We had over 4,000 of our investors who actually came to that webinar just recently. I will drop you a link so you can go and watch that webinar, right? And so you actually see all the detail if you're interested in the detail of it. And I go into much more than I'm going through right now. But this third wave here, to just show you the kind of impact that this wave is going to have, here is an article from The Independent. Africa faces complete collapse of economies and livelihoods if spread is not controlled. And this one here, you can see here, is from the United Nations, right? So this is the United Nations saying, head of development program for regional director of Africa, we've been through a lot on the continent. Ebola, yes, African governments took a hit, but we've not seen anything like this before. The African labor market is driven by imports and exports, and with the lockdown everywhere in the world, it means basically that the economy is frozen in place, and with that, of course, all the jobs are gone. And then it goes on to say, we will see a complete collapse of economies and livelihoods. Livelihoods will be wiped out in a way we have never seen before. You know, it's very different when you're in a place like America or even in the EU where you can just print money. You can't do that in Africa in the same way, or when they've tried to do that, like in Zimbabwe, you had hyperinflation, but they all owe money to the rest of the world. Moody's has just downgraded Africa's debt to junk level, and as a result, the rand, the actual currency of South Africa, has just gone into hyperinflation at the moment, right? It's like it's lost all its value just over the last month. And this is the beginning of what we're going to start to see with other countries around the world as well. You know, we've actually got the same happening now in South America. Let me show you a couple of different slides which actually show you just how bad this is. Total global debt is up to $257 trillion. US national debt alone has gone from 9 trillion to 23 trillion within 10 years. Outflows from emerging markets, which are like the likes of the African countries, has been 100 billion. It's been a record. In fact, here is a slide which shows all of the graphs which actually link to this, and you can see just how dramatic it has been. The cumulative central bank balance sheets in dollars of all the top central banks in the world has gone from just over 5 trillion back in 2006 to over 22 trillion today. So it's just like phenomenal growth in the printing of money. And then you've got the likes of funds coming out of the emerging markets, which is massively more than we've ever seen ever in any of the other crises that have taken place as well, while the Western countries are printing money. This, by the way, isn't just happening in places like South Africa, Italy, Spain. The countries that actually have been hit hardest with coronavirus also are now in big trouble. And there's articles now coming out about Italy having to go for a bailout, where the EU may not be in a position to just keep on printing euros to support that bailout as well. So defaults now beginning in emerging countries, and this will eventually lead to hyperinflation. This might be 5 years down the line before that happens, but it'll happen. So like, as always with YouTube, this is like a time capsule, right? Like we can come back in time and say, well, what actually happened in what order? My prediction is that over the next 3 months, we're gonna see the corporate debt wave start to burst. And we're here right now in April, so we're talking about May, June, July. We're gonna see the consumer debt market actually start to bring down financial institutions in the 3 months after that. And it's gonna be sometime next year, maybe 2021, when we start to see the first like true major defaults and bankruptcies of governments themselves. Argentina is just going through another restructuring of its debt all over again. So we're going to see every one of the countries out there that need help are going to be in serious trouble a year from now. The IMF actually just reported that they've got about 80% of all of the countries that are the ones that could be in trouble are now calling up in distress, saying we need money right now. So with this happening, you say, well, this is a bit like doomsday, right? What does that mean in terms of what I need to be doing, the way I need to be thinking about it right now as well? And so I'm giving you these 5 different elements because the consequence of wave 3 is the end of macro money. There's going to be a whole new world coming for sure, which is going to be about micro money, whether it's private currencies, companies with their own currencies, digital currencies, where we're not going to be necessarily relying on the big nation states to actually give us their macro currencies, right? The fiat currencies. So we're going to for sure see what people have been predicting for some time, which is a total restructuring of our monetary system. We're going to see that for sure in the next 10 years. But what can you do about all of this right now? First of all, number one, maximize the credit while you can. That's the first thing that comes from the first wave. Avoid country-specific at-risk assets, which means that don't spend your time trying to buy into the stock market or into the property market in your country, especially if basically you have got all your money in that currency. Because if that currency drops 40, 50%, then it doesn't matter how much you're thinking that your assets are going to go up by, overall net, you're still down compared to what's happening around the world, right? So there are ways to make sure that you can diversify into a multi-currency safe environment. If you want to say, well, where are those safe environments? There are places right now like Singapore, like China. The places that tend to be doing the best job of actually managing the crisis right now are also the ones that have the biggest long-term plans to manage their economies as well. Whereas in the West, really, the politicians don't have the luxury of that because they're too busy looking at the next election round. So important to be actually looking at where you're putting your money. And you don't have to do this yourself. Get with others, join our group if you want to. I'll drop the links below if you're actually interested, find out what we're up to, what we're doing. Highly recommend that you get with groups that are around the world that already are one step ahead of this and looking at it and saying, how do we really turn what is a crisis into an opportunity to support others as well? Build funds for acquisitions. You don't need to be the one who actually goes out and does the acquisition yourself. You might be with some others who actually are good operators. They can take over a company, they can run it better. We are moving from a shift in wealth from those with debt to those without debt. It's not those who have to those who don't have. It's those with debt, those who owe more to those who owe less. That's how this shift is actually taking place and playing out right now. And invest as much as possible in cash generating fixed income. People say, should I invest in gold? Well, gold's good, or at least it's better than currencies, but gold doesn't actually give you a cash flow. So actually making sure that you're actually putting your money either into a fixed loan or into a fixed currency, a fixed interest structure, which actually is in a safe currency is super important. US dollar is not a safe currency. The pound is not a safe currency. The Australian dollar is not a safe currency. They're all currencies where it's too easy and too tempting for the government just to print more. And of course, the moment the economy starts to recover and there's a glut of money, then that money starts to devalue, right? So while at the moment, all prices are going down, so you could almost say you're seeing inflation happen because prices are deflating, the opposite will start happening as we start to recover, which will be in a couple of years' time, when suddenly you actually see value starts getting created and there's just too much money out there, the money drops in value. So be really, really aware that there are some very specific steps you can take to really be ready for the next growth when the growth comes. Final thing I want to say is make sure you do something which is not even about the money, but is taking purpose over profit. While I've been talking about all of this to do with like how we're managing the things that we're focusing at, we do have a war chest that we're growing to actually go out and do acquisitions, but we're very specifically doing acquisitions within education and even more specifically within entrepreneur education. So that means taking on the right colleges, taking on the right ed tech companies, taking on the right training companies that already have got some great IP, some great curriculum, but happen to be in big trouble because they took on too much debt. Being able to take them on, being able to take their teams on, and then grow that into an entire entrepreneur education group, which is what we're going to be listing next year, where a month ago we're like, hey, we're going to have to slow down on the acquisitions because we don't know where things are going. Now we're at a point where we said like, no, we actually got to accelerate on the acquisitions because there are some great companies that are going to disappear forever unless we actually can go in there and save them. And if we actually can bring them together and then really support them because we don't have the debt, but we do have the cash and we can actually support them to grow, we can weather the storm ourselves by actually making sure we're managing with our team all of our day-to-day expenses and our online revenues. But while we're doing that, we can make sure that we're acquiring the right companies and then helping them to grow. And collectively, we can then support people not to have to go get a job, because we're looking at like 20-25% unemployment around the world. So there's no point learning how to get a job if the jobs aren't there, but really showing them instead of how to get a job, how to create a job, which is how to be an entrepreneur, how to start a business, how to invest, how to just go out and make $1,000 or $2,000 a month without having to go and basically stand in a job queue hoping for the best. What is it we need to do to create that value? What is it we need to do, even from the level of kids, to be entrepreneurial enough that in these hard times, we find the smartest way forward as well. So I hope that you have found this a valuable, useful session on what these waves are that are coming. This is not opinion, this is the data. This is what's actually out there and what's happening. This is not a crisis that it was made by the coronavirus. This is a crisis which is 10 years in the making, which the coronavirus crisis just happened to trigger. But now that we're in it, this is not going to end tomorrow. It's going to be some time. The average time from the drop of a stock market of over 20%, which we've experienced in March, through to recovery in what we call a bear market is on average over 1,000 days, which is like 3 years. So we are in this for the long term. The most important thing is not to go in it hoping for the best, is to plan for the worst and then to hope for the best. So see you on our next session, and do subscribe if you've liked what you heard and you want to make sure you're kept up to date with the very latest things going on, because I'll keep on providing updates as well. And do also click the like button if you've liked this, post a comment, I'd love to hear from you, and we'll leave the comments and links below for you to actually go and see the full webinar on how you can go about profiting from these guys.